Hey everyone, welcome back to Corporate Decoder, the place where we decode the complex world of business finance and figure out if companies are living up to their hype. Get ready because today we're diving into Direct Digital Holdings' latest filing, and let me tell you, it's a bit of a financial roller coaster with some interesting twists and turns. So what's the big news from Direct Digital Holdings, otherwise known as DRCT? Well, it looks like they've been busy making some significant financial maneuvers. The gist of this report is that they've gotten a new loan and used it to pay off some other debts. It's like refinancing your house to get a better rate or maybe just more cash in hand, but for a publicly traded company. Before we get into the nitty-gritty of the loans, let's quickly touch on what Direct Digital Holdings actually does. While this filing isn't about their day-to-day operations, we know they're involved in digital media and advertising technology. Think of them as a company that helps other businesses get their message out there online and track how effective it is. Their stock, the Class A common stock, trades on the Nasdaq under the ticker DRCT. It's important to know the basics of what this company does so these financial moves make a bit more sense. Now let's talk about the main event. On September 8th, 2025, which is the date we're really focusing on here, Direct Digital Holdings, or more specifically its subsidiary DDH LLC, entered into what they call the 8th Amendment to their term loan and security agreement. Think of this as an update or a change to an existing loan agreement. The big headline here is a new term loan called the 8th Amendment Term Loan, amounting to $3.8 million. This loan also includes what they call an interest reserve of $93,000. What an interest reserve probably means is that a portion of the loan is set aside to cover interest payments, making sure those are handled and reducing immediate cash strain. This new $3.8 million loan comes from Lafayette Square Loan Servicing, or LS as they call it in other lenders. Lafayette Square appears to be a key financial partner for Direct Digital Holdings. Now, what are they doing with this new money? Well, this is where it gets interesting. The proceeds from this new 8th Amendment term loan are being used to pay off another debt altogether. Specifically, they're using it to fully repay and terminate what's called the credit agreement. This credit agreement was with East West Bank, or EWB, and seems to have been a revolving credit facility. A revolving credit facility is like a flexible loan where a company can borrow, repay, and borrow again up to a certain limit. It's like a company's credit card, but on a much bigger scale. So Direct Digital Holdings is essentially taking out a new, presumably more favorable or strategically useful loan to get rid of an older one. This is often a smart move if the new terms are better or if it simplifies their financial structure. They also agreed to pay a $37.25. The new loan, this 8th Amendment term loan, has a maturity date of October 30th, 2025. The new loan, this 8th Amendment term loan, has a maturity date of October 30th, 2025. The new loan, this 8th Amendment term loan, has a maturity date of October 30th, 2025. The new loan, this 8th Amendment term loan, has a maturity date of October 30th, 2025. The new loan, this 8th Amendment term loan, has a maturity date of October 30th, 2025. The new loan, this 8th Amendment term loan, has a maturity date of October 30th, 2025. That's a pretty short-term loan, which means they'll need to either pay it off quickly or TERPs. With this latest amendment, the total amount of term loans still outstanding under their main term loan facility is $13.2 million. Now, this is where we see the impact of previous financial dealings. Remember that 7th Amendment dated August 8th, 2025. That's when they converted a massive $25 million of term loans into something called Series A Patel stock. Preferred stock is a bit different from common stock. It often comes with fixed dividends and other rights that are more senior than common stock. By converting debt to preferred stock, the company reduces its debt burden but increases the number of shares that have special rights, which can affect common shareholders. Issuing $25 million worth of preferred stock to Lafayette Square is a significant financial decision. Following on from that, we have a section detailing the termination of that other material definitive agreement, the credit agreement with East West Bank. Effectively on September 8th, 2025, they used the funds from the new loan not just to repay the principal, but also all outstanding loans, fees, and other obligations under that credit agreement. They also got the liens released. A lien is basically a claim on a company's assets as collateral for a loan. So by paying off the debt, they're freeing up those assets. The credit agreement was for a revolving credit facility facility of up to $5 million based on accounts receivable, meaning they're outstanding customer bills. At the time of termination, this facility wasn't even being used for new borrowing, which suggests it was either on its way out or no longer strategically important. Importantly, the company didn't face any termination penalties, which is a good sign. Usually, if you break a loan agreement early, there are fees. Not having those means they likely followed the agreement's terms for early repayment. This next part referred to as creation of a direct financial obligation, or an obligation under an off-balance sheet arrangement of a registrant. Really just points back to all the loan activity we just discussed. It confirms that the new loan and the repayment of the old one are indeed major financial obligations the company has entered into. It's essentially a confirmation that the company is now on the hook for this new $3.8 million loan. Finally, we get to the exhibits. This is where the actual legal documents are referenced, the most important one being Exhibit 10.WID, which is the actual amendment to the term loan and security agreement. This is the nitty-gritty legal text that would detail everything about the new loan. The other exhibit, Exhibit 1.4, is just the cover page formatted for Cambaction. Now let's sort of zoom out and think like a Warren Buffett. What's the story here? Direct Digital Holdings is in a phase of financial restructuring. They're taking on new debt, perhaps at better terms or with different covenants to pay off older debt. They managed to secure $3.8 million, which is a decent chunk of change, but it's a short-term loan. The key thing to notice is their ongoing reliance on secured lending and their willingness to convert debt into preferred equity. The conversion of $25 million in debt to preferred stock earlier in August was a big move to deleverage their balance sheet. Now, this new loan seems to be about clearing out a different credit facility, possibly to constantly chained of $1 million, which is a decent chunk of change, but it's a short-term loan. The key thing to notice is their ongoing reliance on secured lending and their willingness to convert debt into preferred equity. The conversion of $25 million in debt to preferred stock early in August was a big move to deleverage their balance sheet. Now, this new loan seems to be about clearing out a different credit facility, possibly to streamline. The big question for investors is always sustainability. They have a new loan, but the maturity date is very soon. Does this mean they have a plan to pay it off handsomely, or will they need to refinance again? The rapid succession of amendments to their term loan facility suggests a company that is actively managing its debt, but perhaps facing some cash flow pressures or strategic shifts that require frequent adjustments to its financing. We need to watch if they can meet these short-term obligations and if these moves ultimately contribute to long-term profitability and growth. It's a delicate balancing act, and we'll be watching closely to see how they navigate these financial waters. So what's your take on Direct Digital Holdings' latest financial moves? Are they making smart decisions to strengthen their company, or are these just band-aids on a deeper issue? Let us know your thoughts in the comments below. If you found this breakdown helpful, give this video a thumbs up and make sure to subscribe to Corporate Decoder for regular insights into company finances. And don't forget to join our Discord community linked in the description for more in-depth discussions. Thanks for watching, and we'll see you in the next one.